Hello, my name is Steve Bigelow with the Candlestick Forum. We had a major reversal or a profit-taking day, but it was kind of expected using candlestick analysis. One of the first lessons the Japanese rice traders illustrate is the fact that where do most people buy? They buy exuberantly at the top. If you're in the overbought area, and you start seeing them gap up and trade strong up here in the overbought area. As we told everybody in the newsletters yesterday, be ready to start taking some profits. That exuberance usually indicates that's where the sellers are going to start coming in. You had that occur both in the Dow and the S&P 500, the gap up in the oversold area. The NASDAQ did a hanging man. Notice how it gapped up, traded off, and closed back up here at the top end of the range, creating a hanging man Doji type signal. But also notice where it opened. It gapped up. This is why knowing each one of your signals is very important. That told us if things opened lower today, you started closing out positions or taking profits immediately. The candlestick patterns, though, provide us with a little bit of extra padding. There are three major benefits of a candlestick pattern. Our recommendation this past week on Tupperware was a fry pan bottom breakout. Three benefits. One, high probability to know the direction. Two, the magnitude of the move is much greater than just merely an uptrending stock during an uptrending market. And then three, notice what it did today. It didn't sell off. A candlestick pattern will usually hold up even if the market goes against you, because this whole pattern is the buildup of investor sentiment, not indicated or not reflected by just one day's trading of the market itself. So when the market sells off hard, usually you have a day or two extra if that sell-off continues to come out of a pattern trade profitably. The strongest signals was the kicker signal. Yesterday, notice that gap down below the previous day's open and went the opposite direction. This facilitated a good short position, especially knowing that the market was also selling off, that the follow through of a kicker signal is usually a very strong downside. The left-right combo as experienced in Apple in the overbought area. Notice what happened. Gap up, but when they opened it yesterday, look where they opened it. Gapped it up again. Where do most people buy? They buy exuberantly at the top. A bearish left-right combo is an extremely strong signal. In this case, a bearish left-right combo told you probably wanted to take some off the table as far as profitability or profits, that if it opened lower, you definitely wanted to be out of this position. This is all based upon the results of the Japanese rice traders shown us for 400 years what patterns are set up or what signals are set up based upon human nature. So the Dow sold off hard, a bearish engulfing signal, and a close below the T-line. But the magnitude of the move doesn't necessarily mean they're going to sell it off immediately. There might be a little pop in here, the people covering short positions from a strong price move. So you want to see whether this does a bullish harami or whether it opens positive. If it starts trading lower, you definitely want to start going short. That'll be it. We'll see you in the chat rooms.